Good morning, everyone. Happy Monday. Happy Fed week. Maybe not. Where are we at? So we got these sloppy sell setups and other markets that look pretty darn good. Diversity, right? Tales of two markets in a sense going on here. Let's take it piece by piece and get a pointer. So here's a little review. Here's where the markets ignored what was happening in bond market at the time, going sideways. Overall, the market has acted, enthusiastically bullish to ignoring warnings, to starting a downtrend, buying each dip and failing, and momentum moved down into the significant support and the bounce. And see what happened Friday. Gap down inside that day. So kind of a sloppy sell setup, kind of call it, do you feel one of those Dirty Harry things? Do you feel lucky punk kind of trade? Could get whipsawed. Patterns like this, I got to go to the weekly chart when something looks so erratic as that. So breaking last week's low should send it careening down to the October low. Of course, that's not happening right now. You see there, that was overnight and in the middle of nowhere right there inside of that red bar, basically doing nothing, just holding here. So last week's low is a key level. The deeper it goes down there, of course, let's drag this up here to that high. But sideways, right? Things have been sideways, like that for months now, and just in a sideways trading range since May of last year, with a dip down here and waiting, to see if something to start trending one way or another. Ideally, I'd like to see a collapse down to here and set up a buy setup, but right now it's just a lot of wiggles. Sentiment is not at an extreme yet. Breadth is, but it's just hanging below the zero line here. For those that are not familiar with this, it's called a McClellan oscillator. Why is it below the zero line? It's kind of like a MACD, right? Just different settings based on advancing stocks minus declining stocks. 12 minus 26 exponential. So if it's below the zero line, the 12 is below the 26. And this is the difference, like measuring the difference between the two moving averages. So it works pretty well as an extreme. So historically, this is extreme. This was down close to 300 or so when we got the bounce, which is usually happens. It was an erratic bounce, but sentiment, and based on how we look at, using these two internal gauges, sentiment has to get down here along with breadth. And then we look for turning points. And, over the last couple of decades, it works really good. And that's not there yet. And so the ideal scenario would be for it to come down here. And with this sloppy kind of sell setup, ideally it would go down here. Otherwise, we're probably going to be stuck in this trading range for a while longer with the uncertainty of the banks, another screw up again and bailout. And you hear the news that's going on. Anyway, frustrating, but nothing we can do about it. All right, so going nowhere here. S&Ps, just terrible, flip-flopping back and forth, whipping around, and looking for, hold on a second, drag that up there a little bit. Just look at this chart. Look at this volatility index chart, this VIX, kind of what the market is, just whipping back and forth, back and forth. So if you need a measure of, hey, this is crazy, and whether it's the pattern, volatility index whipping back and forth like this versus, more controlled, moved ups and downs or trending, just a lot of uncertainty right now. Next shoe to drop, we've got oil having broken down below these lows, and let's flip that to a weekly chart. You can see it's got this void below with the wide range bar breaking down. Typically, it's going to come down here. And, so we've got oil breaking down and other things like steel and copper, and just a lot of information suggesting that, between after this banking thing, kind of maybe putting the final coffin nail in for a recession to, not that I don't think it isn't here already, whatever, so many people losing their jobs, but this scenario, I think you're going to get whatever evidence needs to be had for them to say, oh, it's a recession. Anyway, gold up, dollar rolled over a little bit normal. Gold's up into this resistance area. And, so this AD line here, right, this is what I'm saying. This advances minus decliners. So what this is made up of, two moving averages of that. But you can see the power on the moves down, and the mediocre kind of, on the moves up is not getting that extreme. So it's a little more confirmation of it's a bearish market environment. All right. So whipping around, going nowhere. SPX average now is around 84 points. From where we're at, let's see, if we said the most extreme day, give or take 84 points, where would that put us? Where is their premium? And well, the market moved up a little bit more. I had 40.10, but 40.05 is within the 84 points, but pretty far away. But you got the 50 MA there in that area. And got that swing high there on the hourly chart, which you can see. So not the greatest. I mean, the greatest is like we want no brainers. It's just not going there. It ain't. But that's far enough away to be reasonable. And yeah, I got the same Jake 38.05. I wish I had 3800. Is 38.05 still good? 35. 38.05 is 60 by 70 now. 55 by 65. 38.10 right here. So it's down here. 38.10 is down here near support. It's below the $84 range. We know it's up here a little bit. So take your choice. I think either one could work today. It isn't likely that the markets are going to move significantly. There's no economic news. And, Fed Day Wednesday. So probably somewhere range bound anywhere within here, within that whip. So either side, I think, would be fine. All right. So consolidating at resistance. This is the silver lining in this market. Tech, interest rates going down a little bit. Money goes into tech. Money leaves banks. I guess it feels comfortable in Microsoft and Meta and so on. AMD, by the way, some semiconductors did well. Intel, that dog, rallied right back up to the trading range. So there's good signs there. The tech is doing well, but overall, it's just a different trading range. Just a smaller trading range within a big trading range. It'll end at some point. So Russell moving up, that means, well, one of the things that it means is that institutions are feeling happier this morning, willing to do some trades in what's considered more speculative. Overall, it's down here at support. This bar isn't done, but breakdown failures after moves like this aren't unusual. It has been slopping back and forth In a sense, unless this gets back up into here pretty darn fast, think about this on a closing basis. It's down here flipping back and forth, and it's just down here at the bottom of this wide range bar. So it is extended short term. And so the idea, like what I said with the S&Ps, do you feel lucky punk kind of trade as far as a short goes when things are down a bunch like that so quickly? It's more likely to get whipsawed. And so this is an initial whipsaw. And the longer it spends down here without being able to get back up into this area, the greater the odds that it's coming all the way down to the bottom of the big trading range. So I just drag that up to the top there, and you can see you've just got a big trading range going on here since the middle of last year in different ways in all markets. There's a lot of running in place. Now this one, last week, this entered the void. That topping pattern, the breakdown to the bottom of the wide range bar on the weekly. And unless this has some kind of miracle recovery, getting up back above these highs, and I would say it needs to get back up above 33,000. This is just waiting for it to enter in a collapse down into here. So when you have time, can you compare what is happening now with the 2008, with the Bear Stearns days of 2008? I have to go back and look at the charts, but I think it's different than back then. What time is it? So here, and in the weekend video, I covered some monthly charts and how things are come down a bunch and forming bottoming type of patterns, and whether even something like the S&Ps, if it was to come down, to form some kind of a head and shoulders bottom over the next couple of months. But, 2008, we have to hope that something like, it seems to me what's happening now with, these banks coming to bail out other banks, and with the feds coming in to do, they're doing what they should do to avoid 2008. But you can see, what happened back then. And when I say we better hope not, because what would be happening right now would just be a prelude to this. And I'd have to go back and look at the internals, but you can see this pattern back here where, and historically, if you go back and look at decades and decades of tops before major collapses, they look similar to this, where they were in uptrends and they have an initial break like that, and then a retest, and then the collapse. And we can look at that now. We're pattern traders. And so now we don't have that kind of a pattern. So there are intermarket relationships, and there are patterns and market internals, what I call techno fundamentals. And you have to match those things up, because it's not just patterns, but we don't have that pattern right now. That concerning kind of a pattern, like we did at that time. So the other thing that we don't have, and I'd have to go back and look, and that would get kind of a lengthy discussion, but we do have some things to be concerned about that happened recently this week or last couple of weeks, is that the transports started to break lower, copper started to break lower, steel started to break lower, airlines, cruise lines, and that type of intermarket relationships, where all of those things start pointing toward a coming recession. And we hear about people losing their jobs versus, hey, is this banking thing more of a concern? And I think not, from what I do know about it and what I've read, in that, hey, if this bank, if these people didn't go and take their money out of that bank, right, the run on the bank, and it's their money to do, of course. But anyway, if they could have held those bonds to maturity, they'd have made money. So, they did an investment that, like any investment, could have worked out. Interest rates were going up. Those bonds lose value. And now certain individuals start to think, and all these institutions, hedge funds, banks, they all kind of they move in a herd. They do the same things. And that's why when somebody says, that analogy about cockroaches, you can be damn sure there's cockroaches out there, so whether it's First Republic or the ones 2 weeks ago or Credit Suisse, they all do the same stuff. So there's problems out there, and that's the real concern. So now we hear, is there, banks coming, to help banks, and that's all good stuff. It's just terrible that, these regulators who want to regulate and protect us from ourselves with things like pattern day trader rules, the buddies in the banking system and hedge funds get to F it up one more time, and the government comes to bail them out. No one's bailing us out. Well, don't get me started. Anyway, I don't think we have that type of scenario right now. All right. Interest rates just hanging out here. So we're going to be hanging here, I think, for a couple of days to see, how things shape up. The dollar, which we already looked at, that's coming down. It's going to help gold a little bit. And Bitcoin had a hell of a few days there, calling back from the cliff. Money finding a place in turmoil and going to Bitcoin. So, keep the powder dry, trade small, and we'll see what happens after Wednesday. All yours, Dan.
Good morning. Yeah, you better believe there's cockroaches everywhere. So Credit Suisse had to get bailed out. And do y'all remember just last week, I think it was on the gap down day, the CEO comes out, oh, there's nothing wrong with our bank at all. Don't you worry. And, I was talking about that, lying SOS, Hall of Fame. And then the UBS guy comes on today and says the exact same thing. UBS, the paper said it was a forced merger. So, it's probably their Fed doing the same thing. Like, remember, we were talking about that last Friday in the green room, how Bernanke over the weekend forced a bunch of mergers. That's why we have JPM Chase, for example. Bank of America bought whatever it was. So more drama, of course. This Frick, what happened to my pre-market? Frick, the ratings agency now, I guess, decided to wake up and give them a downgrade now. Where are the rating agencies back here? I mean, yields have been going up for a year and a half. And now they come to the party. Goes from 150 to 23, and now I'm going to downgrade your junk. Oh, and on that Credit Suisse, I heard one of their level of bonds got totally wiped out. So this gap down's reflecting the bailout amount. But I actually had KRE as a put spread in the weekend letter. I made it hard to trigger. It'd be over Thursday's high. But these things are so cooked, whether they make a new low or not. I'm looking for opportunity to trade them for whatever. But KRE would obviously have less gap risk than an individual stock. Yeah, Thomas, that is just amazing strength. Greg mentioned the tale of two markets. I mean, that's just amazing chart right there in light of everything that's going on. some of the FANG, it was a FANG party last week, Microsoft. Look at Apple. Apple's a 1, 2, 3. Bullish engulfing weekly. I like the fact that it's down a little bit. But yeah, I think, you got to assess the risk of holding into the Fed announcement Wednesday, 2 p.m. But I have no problem swing trading ahead of that time, day trading. Berg, $26. That's a big bullish gap. It's a Climo with a 180 reversal. Let's watch that on a pullback. Here, I'll put it right here in this middle chart. Bottom right, PDD had earnings. That's a bearish gap. 80 and change. It's a big gap, but bearish as can be. That's a specialty retail. NEM had positive Barron's mention, but what jumped out at me was this monthly. That is the start of a potential double bottom on the monthly with a big old void. So that's ideally, it's up a lot here at the 5,200 and resistance. Ideally, we get 2 inside bars for 1, 2, 3. NYCB, the FDIC did. I read something. They did something with giving them a lifeline and getting rid of some of their junk bonds or whatever. I didn't even care about the details. That is a monster gap up. I mean, this looks like so many out there. Look at the size of that gap. Amazing, but nothing to do with it now. This had earnings. I can't tell where it is. FL had earnings. That's a bullish gap. I'll put that in my other computer. FL. And then, this is Foot Locker. So obviously look at Nike. Nike's making a turn. And that's worth watching. Wall, another bank. I had set an alarm at 34 right there on the top of this. The alarm did go off. This could very well set up a day trade long. It's Swiss. I'm not going to even watch you anymore. UBS was, thanks, Patrick. UBS was down. Now it's up. Maybe it's up because the CEO said that they're rock solid. Kidding. Here's another day trade, gap into 11 bucks. Nice little kind of cup and handle buy setup here. I'll put that in the other computer. It looks good. This is one that got devastated also. I'm thinking it would be the next on the chopping block. That and Frick. This run on the bank, I mean, it is a problem. You don't have enough money. I mean, a bank should be a simple, boring business. You take in deposits, you make a couple points on the spreads, and you manage your longer term assets. So, but if you don't do that, you don't, so that was a real problem. Then of course it can go out of business. XBI. And XBI is a bear 1, 2, 3 on the weekly chart. ARKF. Big consolidation here, but the weeklies, look at the monthly. I'm going to keep an eye on this for a core long. I'm going to add that. Alex, I know, Alex, you mentioned one of the ARK ladies last week. I forget which one. But I'm gonna add this to my core list. All right, I'm gonna get that one. Okay. I like RGF better. You know, we'll come back and do the optometrist test later, but I like daily, weekly, monthly better on RGF. WBS, another one of these banks. My alarm at 40 went off. That could be another day trade, although this one's at the prior high, so I got to see how it's going to react. Boot had a favorable Barron's mention. I just see one print. We'll come back. KDP favorable Barron's. Bullish gap. This would be more of a no-brainer put spread, but it's a gap breakout. We'll come back to it. Charlie Bravo, favorable Barron's. These insurance companies got whacked along with banks. Q is actually the most bearish retracement here into the market open. You know, last week it was obviously the stellar. Darden's had some favorable Barron's article also. But what I like about this one over Friday's high is a breakout daily, weekly, monthly. It's in a trading range with 2 breakdown failures. Thursday had a closing breakout. Ideally, I get 1 or 2 inside bars on this. And then that's showing great relative strength. On WU, my alarm just went off. So that, oh no, my alarm was, no, okay, so WU is a Climo. Raul, give me a second, I'll look at your EME. Square low alarm. That's a Climo, so I like 5-minute high. Raul said EME. It's sloppy, but I do like the monthly. I had that. No, that's not it. I'm sorry. It was something that looks similar to that I was looking at last week that had a deep retracement. I would say 30-minute high is fine. PDD bottom right is bearish, so WU 1096 now. Is the new high. New alarm. AD line 1100 on Q's the weakest. Shop. My alarm did go off. Okay. All right. Thanks, Steve. Yeah, I'll update it. And I had, what else? I had Square alarm go off.